We're here on the floor of the Traders Expo. My guest today is Price Headley of BigTrends.com. We're talking to him about acceleration bands and how he uses those to find good opportunities. So Price, first of all, what is an acceleration band?
Basically, our focus is that when you're a trader, you want the maximum move in the minimum amount of time, especially if you're an options trader, which is our particular focus. But we do a lot with stocks and ETFs and futures as well. It's all about finding those sweet spots where something makes that unusual move. You know, that a lot of times things are bumping between support and resistance. Our experience is that that's not where the bigger opportunity. The bigger opportunity is really when things break outside of that support and resistance. Most people can relate to that just when things start to break to a new high or a new low, but we're rather looking at what that trend has been, and when it starts to go more parabolic, when it starts to either accelerate to the upside or starts to, that waterfall effect starts to fall off the cliff, that's where you can make a lot in a relatively short period of time. You have to know how to manage that risk, but our acceleration bands indicator really helps people to see that. It's all based on the trend and the stock's volatility. So, you know, just factoring in the more volatile it is, the wider those bands are going to be. And also, if it's been trending, that band is trending up. So it's got to get a real acceleration, it's got to move even faster than whatever that recent rate of growth has been. So that's something that helps us to find that parabolic bubble, if you will, that starts to really accelerate. And it also tells us when the bubble pops. So it gets you out. You're never going to get out at exactly the top, but if you truly follow the indicator, but it's going to tell you when it's time to walk away and move to the next opportunity.
All right, so talk about those breakouts of support and resistance. The question I hear a lot of people asking is, how do I know at what point above that to buy or what point below that to sell? Because it could come back up and then pop right back in again, and you're never quite sure.
You know, it's exactly right. You know, we talk about there's a big difference between a true breakout and a lot of the fake outs. You know, so many traders are getting whipsawed because they think they see that move through that resistance and starting to break out upside. But the reality is that one bar, we say, it doesn't make a trend. We look for two straight bars outside of our acceleration bands. So we see a lot of times where it'll try that one time and it'll fake and shoot right back down, and sometimes violently. So you really have to make sure that, hey, when it gets into one of those steady trends, like say Apple has been in here recently from the move from 450 to the low 500s, it was really just a classic acceleration up over about a 6 to 7 day time span. So really, you know, happened where you made that kind of a move on that big of a stock, and it shows you kind of that pile-on effect. It's like everybody wants in. There's a tendency a lot of people have to think they have to be a contrarian on these things, and I've learned once they start accelerating, you just need to get on for the ride, and then basically you have to just have good trailing stops, and we've got a couple of rules that we use for basically a moving average that we trail with, as well as the bands themselves. So whichever one basically gets violated first tells us to start backing off and moving on or waiting for that next opportunity.
All right, so let's talk real briefly about that trailing stop. How are you doing it just below that acceleration band, or how are you deciding?
Yeah, well, you know, we've tested a lot of different moving averages. So, you know, moving average is a very simple concept, and what we find is the exponential moving average works a lot more effectively because it's faster than a classic simple moving average. Quickly, that just means the simple moving average is an even average of all the recent closes. The exponential puts more weight on the latest closes than the older data. So we'll typically test and use a very short-term exponential moving average to allow folks to say, okay, this is something that's going to keep with that really power uptrend or downtrend, but when it does turn significantly enough, it will have caught up. And some of the best trends, the exponential will actually be outside of the acceleration bands on the upside, catching up faster because it's just moving so dramatically parabolic, and so that's going to get us out first in that kind of a move, versus some of the kind of steady acceleration trends where they just keep on chugging along outside of those bands. The bands will usually get us out before even the exponential moving average.
Price, thanks for your time.
My pleasure. Thanks, Tim.
You're watching the MoneyShow.com video network.